Hey there, Kenneth French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Kenneth French, Vast Voice, telling business secrets to entrepreneurs. Really glad you stopped by. Tax hack time with Kenner. Hey there, Kenner French from vastsolutionsgroup.com. We're going to help you by learning the top 10 hacks to lower your tax liability. This is mainly for entrepreneurs, real estate investors, really, or anyone who is a high net worth individual who's looking to lower their taxes legally, morally, and ethically. Once again, Kenner French with vastsolutionsgroup.com. So, the top 10 easy tax hacks. So these really are going to be easy ones that really can be defined by not taking a lot of your time, not even taking a lot of the CPA's time or tax professionals' time to lower tax liability. We're going to go from 10 all the way down to 1. Stay to the end. You're going to get a bonus. You're going to be really happy you stayed here with us here. Why does this matter? More real estate investors, they're thinking, well, wait a minute, what's one way I can cut, expenses? One way of doing that is tax liability. And by the way, the IRS will not tell you you're overpaying. If you wrote a check, let's just say for $100,000 to the IRS, they're not going to say, well, I wonder if there's a way you can lower that tax liability. That just won't happen. Well, by the way, by spending some time here, let's say it's, 30 minutes, 40 minutes, an hour, whatever the case is, you're going to end up lowering your tax liability. It's going to be worth your time. Stay to the end. The bonuses are big, and you're going to get some specific bonuses that are going to lower your financial output by being here. Once again, vastsolutionsgroup.com. Who are we? We specialize really in working with real estate professionals, usually, real estate agents, real estate investors, fix and flippers, or, even sometimes guys who like to keep their entities for a long time, being real estate entities for a long time, and they do buy and holds rental income. So who are we? Been around for a long time, really since 1969, started by a guy named Gary Coons in Bellevue, Washington. We're now located and headquartered on Bainbridge Island. We have business all over the country. By the way, here you see Bob Bloom. He's an attorney who helps us with vastassetdefense.com. That's our sister company. He and I partnered because he is a big time attorney. He knows what it is to really help in structuring companies. So really, they are fine as far as asset protection goes and also estate planning. His company, Asset Defense Team, has been around for some time. The reason we decided to really join forces with vastsolutionsgroup.com is because we knew that our clients are getting bigger and bigger and bigger, and they want to protect their assets. Hence, we have now formed vastassetdefense.com. There you see Lily. She's with us here at vastsolutionsgroup.com, our general manager. And here, we couldn't do it without our team. And there, a little bit more about myself. You see an AI-generated picture of me. We've been doing artificial intelligence for some time. We're not new on the block. So many people say that, they're gurus as far as artificial intelligence. We started researching in 2010. We started our own model in 2018. It's called Einstein. And the reason we started that is we knew that it wasn't enough to have humans lower tax liability. You can only do so much as a human capability. So what we tried to do and have done successfully is we prognosticate what the tax liability is going to be, and we lower the tax liability as a result by de-engineering or re-engineering the output. We don't want to say here, this what your tax liability is. We want to know January 1st of the previous year what your tax liability is going to be. And then what we call market. We try to lower the tax liability insofar as we know the tax liability potentially would be, and we try to basically just de-escalate or minimize the taxes to the extent possible by the actions that we can do on an ongoing basis to lower the tax liability. Anyway, that's our team here at vastsolutionsgroup.com. A little bit more about myself. I've been around in the business running vastsolutionsgroup.com since 2006. I've written a number of books, 3 books, another on the way you'll learn about in just a little bit. I was a small business contributor for Forbes.com. I now am an AI and tax contributor for the AI Journal. I have a number of things that I've done as far as speaking all over the world. And I'm out there, obviously, trying to lower tax liability legally, ethically, and morally. And that's what we do here at vastsolutionsgroup.com. There you go, vastsolutionsgroup.com. I'm just going to say, go to our website. You're going to learn a heck of a lot more about this presentation. There's going to be some free bonuses on our website at vastsolutionsgroup.com. Let's go over it really quickly. Remember, it's tax hack time, so we're going to go through this relatively quickly. We'd love it if you have any questions by going to the website at vastsolutionsgroup.com. Once again, if you have any questions. And also, again, for free bonuses, etc. Easy tax hack number 10, set up the right entity or entities. So many people don't realize that by having an entity provides asset protection. Also, it can help lower your tax liability. I'm going to talk about one specifically. S corps. In a lot of cases, so many, let's say, real estate agents don't realize that if you have an S corp as defined by the IRS and put together to lower the tax liability by having a salary, that can lower your tax liability sometimes exponentially. So let's just say you're a real estate agent and you're getting whatever $200,000 of gross revenue coming into, well, probably your Social Security number. That's the way it's done if it's a sole prop. But anyway, and you decide, all right, $200,000 I'm paying total income tax, payroll tax, et cetera, on $200,000. Smart? And no. Have an S corp with a salary that would be a market salary for what you're doing. Let's say instead of $200,000, you lower it to, let's just pretend $50,000, whatever the number is. It doesn't really matter, but just for argument's sake, you're paying payroll tax on the $50,000. Your payroll tax is going to be higher than the income tax that you would be paying on the $200,000, because the $50,000 of salary, you're paying higher tax than you would be on the additional, therefore, $150,000. So why is that important? Because that's an easy fix that can lower tax liability. I was just talking to a client last week, and he said, well, my CPA said it's going to be too much work. Really? Is it too much work to save, in that case, $14,000? Well, yeah, sure, you have to put together an entity. Sure, you have to, by the way, by putting together an entity, it lowers your increases your asset protection barrier, number one. But number two, on a net basis, in their case, I should say, because husband and wife, really, $14,000. Well, okay, let's say you have, payroll taxes, not payroll tax, but, to set up the entity and the kind of the logistics behind it. Let's just say it costs $1,500 a year. Well, $1,500, well, that's nothing in comparison to $14,000. Think about that. Just think about that. Asset protection increases and your tax liability decreases. Really? Too much trouble? Anyway, I can go into that all day long. But what I would say is that's an easy tax hack. I mean, again, this is tax hack time with Kenner. I'm trying to lower tax liability legally, ethically, and morally. And when people are out there saying ridiculous things like, it's too much work. Well, who's it too much work for? Think about that. That's no work in general when you're comparing it to the monies that are involved in helping the client. By the way, I'm sometimes talking to people who are saving $20,000, $30,000 by just that act, by having the right entity. And that's just one example of an easy tax hack. Now, what I would say, this is important, consult with a professional. I would say either go to the website at vastsolutionsgroup.com or talk to your CPA, talk to your tax provider, talk to your tax attorney. If they don't understand the concept, run. But if they do understand the concept, maybe you can work the math. Just see the math. That's all this is a mathematical analysis. Hence the reason we decided to put together Einstein, our AI model, to help us to see if it's going to work out. Because you can get a numerative value, quantitative value, to see if it's going to work out. And that's the way to put together any tax plan. See what the end result is for you, the client. If it works out, looking into all the elements that are important to you, which are numerical, well, it's probably going to make sense. But why do I say consult with a professional? Maybe even go to the existing professional. If they do know the situation, by the way, they should have presented it first. But what I would also say is, well, think about it. They know your situation. Your existing CPA, your existing tax professional knows your situation better than anyone. But if they don't understand some of these concepts we're going to talk about, we're only on number 10, right? You're probably thinking, whoa, that might make sense for me. We're only on number 10. But what I would say is, if they don't understand some of these concepts, give us a call, give us a check in our email. All right. This is one of my favorites. We have an actuary, we have a mathematician, we have a TPA, third-party administrator, who helps us with some of these concepts. Now, I would call this number 9, easy tax hack. This is really easy. Now, why am I saying this one's so easy? Well, it doesn't take much work for you, the entrepreneur, whatsoever. The CPA, the tax provider, it does not take much work whatsoever. Here, we're going to be talking about a smart tax hack in this one. Let's say you decide to put in real estate into your self-directed IRA or self-directed 401k or self-directed profit sharing plan, defined benefit plan, cash balance plan. You could save so much money in taxes because if you're buying, selling, especially short term, which we're going to get into a little bit, you don't get hit with, and this is a beautiful thing, you don't get hit with taxes. Now, I'm going to stop here for a moment. Everyone is always saying to me, I can't put in real estate into my self-directed IRA. I can't put in real estate into my 401k. Whatever. Show me somewhere where it says you cannot put real estate in a self-directed IRA, quote, self-directed IRA, or a 401k. Really? I haven't been shown a I've been doing this for many years. Really, if you really think about it, since 94, I've never once seen anywhere where it says you cannot have real estate. Now, nowhere, because I know it's not out there. I've looked at case law. I mean, believe me, we've analyzed this left and right. It's just not out there. IRS doesn't care as long as you're doing it along the compliance lines. Who really cares? The IRS doesn't care. Whatever. Now, I will say this. Some financial advisors would say, no, don't put real estate in your IRA or your 401k. I get it. We have an investment company as well, but they don't want some don't want you to put real estate in your IRAs because it's out of their compliance fiefdom. One. Number two, also, frankly, sometimes I don't get paid on it. So those two things combined make sense for why they're going to tell you don't put real estate in your IRAs. Real estate's it's a tangible thing. I think in so many cases, it makes sense to put real estate in your IRAs or your 401ks. I think, me personally, and I think most people would say, or crypto, by the way, if you put in real estate and or crypto, really real estate, into any investment portfolio, usually it will be one of the best performing assets. And if you're doing it right, if you're listening to the right consultants, right mentors as it relates to real estate, you're probably going to make more money than if you're putting in any other asset class. What asset class can you think of that can put money? You could put a down payment of whatever, sometimes zero, of let's just say 10%, of 1%, of 3% of the overall investment in real estate, and all of a sudden it go up. Your cash on cash rate of return is huge. It's one way of doing that is in a self-directed IRA or 401k. That's the way to go as far as, in my opinion, as far as any retirement. If you could put in a self-directed IRA, Roth 401k, et cetera, it's a smart thing to do. It's something you should think about as an investor. Now, I'm going to give an example as far as Roth goes. Why is a Roth such a big deal? Because you put in money, as long as you're abiding by the rules, by the way. If you're putting in money in real estate, let's just say in a Roth, and it has a huge run up, right? You don't have to pay taxes every year. And when you pull the money out, you don't have to pay taxes. Wicked smart idea, right? That's a brilliant idea. Wait a minute. So what you're telling me, Kenner, this is, again, easy. This is a tax hack, right? We're talking tax hack time, right? You put in, let's just say the real estate, you put in 100,000 and it goes up to, let's just say it to be crazy, 10 million bucks. You mean every single year I don't have to pay? And I know that's a gross example. Every single year I don't have to pay taxes. One, yes, I'm saying that. Two, when I pull the money out, as long as I'm abiding by all the rules, I pull the money out, I don't have to pay taxes. That's exactly what I'm saying. A Roth IRA or a Roth 401k makes a lot of sense in that case. A lot of sense. By the way, again, going back to the earlier point, consult with a consultant, a tax professional. But what I would say is, depending on the circumstances, and usually putting money into a qualified plan, that being an IRA, 401k, Roth IRA, Roth 401k, makes a lot of sense. That's a huge tax hack, a huge tax hack that a lot of people don't know about, and they need to take advantage of that. Okay. Also, by the way, using other people's money, you can invest, other people's money in your retirement funds. It is legal, without a doubt. All right. Easy tax hack number 8. I love this one. Maximize depreciation. Depreciation as a real estate investor is your friend. Now, believe it or not, basically the way tax laws are written, it's written for two people, I would say, if you will quote people, real estate investors and entrepreneurs. We have an entrepreneurial mindset. When they put together the tax laws, it was basically made for helping people to expand the the US's coffers, if you will. And one way of doing it is maximizing depreciation. You make money by utilizing depreciation. And there's ways, I'm not going to get into this specifically, but there's ways to accelerate depreciation or really use it as your friend. You can use it, there's bonus depreciation. I'm not going to get into all the specifics, but what I would say is, and this one is debatable if this is Easy Tax Act, but what I would say is, depending on your circumstance, it can completely help you as when you take and utilize the depreciation method on your real estate. I'm not going to go into specifics, but I'm just going to say that this is one of those that it's worth looking into, worth talking to your tax provider. It can get really, really complex. I mean, really complex. But the ease of it from an investor standpoint, it's without a doubt something to look into. All right, let's go into number 7. Remember, Tax Act Time with Ken and French. I am so glad you're here spending it with us again. You're going to get bonuses at the end. This is going to be worth your while. Shift income strategically. So there's ways that you could pay, all legal, you could pay your kids potentially money that you would have taken. And because they're a lower income tax bracket, it could be tax specifically strategic to you as a business owner. It's worth you thinking about. Because who knows, maybe even you can put, instead of you, I'm making this up, you making 100,000, you making whatever, 85,000 and moving money to a spouse or to a child at a lower tax bracket, they could put their money into a Roth, let's just say, a Roth 401k, let's just say. So what happens then is, well, if they have a bunch of real estate, as I mentioned earlier, it goes up and up and up, meaning the portfolio, they pull the money out down the road, they're not hit with taxes, and it's a favorable thing. I'm going to also remind one thing. This guy named Peter Thiel, who's a big, rich, famous guy from PayPal. He's one of the founders of PayPal market. So what he did was he put his shares of PayPal and actually other assets in as well, which I'm not going to go into. But he put it in at a low valuation. I think it was $15,000 when the portfolio or the investment was worth almost nothing. And then supposedly it went up to as much as $5 billion. Privately, I don't believe that. His portion didn't go to $5 billion. That's a whole nother argument. That's what it says in the press. Anyway, he doesn't have to pay taxes on that. Now think about that. Think about that story. Now, wouldn't you like to be in that camp? Whatever it is, 15,000 to 5 billion, even if it's 3 billion, even if it's 1 billion, you get it. So what he did was put money into the Roth. Now, he also did that for his wife. Think about that. Or not his wife, sorry. Some family members, not his wife. That's really, there's a lot of stories there. But anyway, so think about that. He moved the assets to family members. Moving some of the assets lowered his tax liability and helped him on a net basis. That's one. Number 2, management company and opco, or sometimes they call them holdco management companies, however you want to call them. So there's ways to make more flexible your cash flow because you have assets in one asset versus another, even if they're, by the way, you can change the timing of the end point of that entity, and it can also help you with asset protection, cash flow purposes, and also taxes all at the same time. So there's a bunch of things you could do as far as kind of shifting the income and even the timing of the income to lower your tax liability. People don't realize this. Let's just say you pay legally, by the way, you pay a bunch of expenses at the end of the year, right? Depending on your circumstances, that could save you cash as far as taxes versus maybe even waiting to pay some of those expenses later. So there's a number of shifts you could do, but shift income strategically is one of the things you should think about. Again, Easy Tax Act number 7, Tax Act Time with Kenner. Easy Tax Act number 6. This is a big one. We were just now working with a client. It's a couple, you check a box on the IRS form saying that you are a real estate professional, or sometimes they call it a reps. Okay, now what happens by doing so is you are telling the government you're working over 750 hours a year, and also potentially a material amount, 50% of your time is spent on real estate activities. So what does that mean? You can deduct all real estate losses against active income. I'm going to go into a little bit more specifics down the road in the next slide, by the way, but you have to meet the IRS time and activity rules. But what I would say is, in a lot of cases, just by checking that little box, Easy Tax Act, by checking that little box, what happens? You can lower your tax liability, make more money right off the bat. Let's go into that real quickly. Here's an example. This is a real story. I've made the numbers a little bit more simple. So Here, Sarah makes $100,000 as a W-2, let's just say. She's in the 24% tax bracket. It's not exact, but let's just go with that for this story. Okay. She has $25,000 in net real estate losses, brand new to real estate investing. Okay. And it's because of depreciation. Also because there's expenses in the portfolio as far as real estate goes. Not going to go into specifics there. That could take all day. Anyway, but this is simple. So look at it this way: $25,000, right? That's the net loss she has on the real estate side. But because she checked that box on the IRS form, right? And she's in the 24% tax bracket, she saves in that case $6,000 in federal taxes. I didn't even include state in that. So think about that. So 25,000 times 24% is $6,000. That's how much, because they checked a little box on the IRS form. That's how much they saved. Think about that. You can't get much easier than that. If you're already spending it, in this case, her name wasn't Sarah. In this case, 80% of her time was in real estate, and she was spending about, about 800 hours in time in real estate as well. So think about that. So right off the bat, all you have to do is check the box and you get some big tax savings. $6,000. Maybe to you, $6,000 is nothing, but it's something. By the way, in some cases, it could be a heck of a lot more, but I'm just giving that as an example. Again, this is Tax Hack Time with Kenner and vastsolutionsgroup.com. If you have any questions, please go to the website. We're there for you. All right, easy tax hacks number 5. Deduct travel the right way. Now, if you do a property tour, let's say you're going to check a piece of real estate, what happens? Are you going to pay for it out of your own pocket? By the way, hopefully not. And we can get in that all day, but what really you're doing is you're doing something to help your business. Okay. You're helping the real estate enterprise, let's just say. That's deductible. Think about that. That's deductible. The government's giving you money for your, plane, to a certain extent, your food, gas, rental car, hotel, the whole deal, right? The government's paying you to do that. They're paying you to do the research. And if you have a piece of real estate, as an example, I shouldn't say a piece of real estate or a real estate investment, and you go to analyze the real estate itself and make sure that the enterprise is going well. If it's buy and sell, short-term hold, doesn't really matter. Same thing, deductible, right? Seminars and conferences. Same thing. You can deduct seminars and conferences. If you're in Washington State where we are, and you're going to whatever, Florida, that flight, you're going to a research seminar, deductible. You just have to properly document it. And we're going to go into some documentation portions actually right now. Okay. And this is a super easy one, especially nowadays with all the AI things that are going on. Leverage AI-powered bookkeeping tools, because that will help you to lower the tax liability. You'll have clean finances because you've put all the numbers into, let's just say, a spreadsheet or something with respect to AI. Plus, by the way, by having all these cool bookkeeping tools nowadays, you save time and you get to reduce errors. Reducing errors is a big thing. You don't want to have errors on your books in case of audit. Plus, if there are errors, you don't know if some of the numbers are clean, if you're doing a good thing with certain investment here or there. Speaking of analysis, you want to make a good analysis if the investment is making sense. How do you know if it makes sense if you don't have clean finances? With AI out there, you can have clean books, good books, etc. And plus, you can optimize taxes. You can give your books, the AI-powered books, to your CPA, your tax provider, and then he or she can put the money in the taxes, or put the numbers in the taxes, and it could be helpful for you. Now, what I would say is, actually, we're going to go over something real quick. We have, and as I mentioned, we've been doing artificial intelligence for years, right? So we have a bonus that at the end, if you sign up with us, if you do decide to sign up with us, you'd be crazy not to. If you go to our website, vastsolutionsgroup.com, we internally call it vastbookie.ai. We have a free AI-powered bookkeeping platform. It's a cool system. Put in the information. It does a lot of the bookkeeping for you. You won't need a bookkeeper. You won't need QuickBooks, and it's tailored, generally speaking, for real estate investors. Although it works for others, but it's awesome for real estate investors. I'm going to go back to that. Go to our website, vastsolutionsgroup.com. What I'm going to say is, if you're interested, we'll put you on the wait list. Go to vastsolutionsgroup.com, sign up. There'll be a pop-up, and there you'll see how to sign up for it. For anyone watching this, as long as it's within let's say 1 week period by the end of the week. That's what I'll say. By the end of the week, as long as you sign up, email us letting us know that you've received this video and you want to sign up for free bookkeeping. Go to vastsolutionsgroup.com and sign up. We'll do it for free. For the first entity, I got to say for the first entity, by the way. And that's automatic. That's a bonus that's being provided to you. Easy tax hack number 3, know your short-term versus long-term capital gain. This is huge, man. So think about this. People don't realize it. We were talking to a client who he didn't realize that short-term flips were taxed at a higher rate or worse rate for a business owner, for a real estate investor versus long-term. If you keep the real estate for over a year, whatever the long-term capital gain rate is at that time, generally, that's what you'll be taxed at. So it's better to have assets for over a year versus under a year. Let's say you buy a house, I'm going to make this up, January 1st, and then you sell it February 1st as an example. You're going to have short-term capital gains, right? So meaning whatever your tax bracket is that year, that's what you're going to pay. It's not as good. But what I would say is if it's a good investment, it's a good investment. I don't really care. If it works out, it works out. But what I would say is, generally speaking, long-term capital gains tax-wise make more sense. Now, what I'm also going to say is I'm going to take you back a little bit. Remember qualified plans? We were talking about IRAs, Roth IRAs, et cetera, maybe 401ks, cash balance plans. Well, what I would say is if you're doing short-term flips, it makes sense generally to do those in a qualified plan because you don't have to worry about short-term capital gains. Hence the reason I made that comment earlier in whatever it was, Easy Tax Act number 9, I think it was. Does that make sense? Now, but if you're doing flippers, short-term, real estate investors, et cetera, totally different tax category. So here what I'm saying is look at long-term capital gains. Now, meaning look at keeping your real estate for over a year. Now, on the flip side of that, there are these things called installment sales, 453A, where let's just say you've made a huge amount of money in a short-term deal. Again, using January 1st to February 1st as my pretend example. All of a sudden it goes up, the portfolio goes up from, I don't know, let's just say it's $1 million. Okay, you're a big hitter, it's $1 million. There's ways you could kind of extend your thing called conditional receipt where you don't have to worry about taxes until you take the money in. That works here for real estate just like it would for a business, by the way. So there's ways to strategize. If you do have a short-term capital gain, there's ways to kind of help your tax situation a little bit more than if you're taking it all up front. Now, this is the concept is easy. The work involved is a little bit more work. I will admit that, but it's worth you looking into if you do short-term, let's say, deals. All right, this is so easy. Easy tax hack number 2, home office plus education. Now, again, this concept is really simple. Your CPA will determine, or tax provider will determine what is the best for you in this situation. IRS compliant home office deduction. You claim a deduction for the portion of your home that's used for business purposes. Now, there's a whole bunch of ways of doing it, but you could do the Augusta rule where you go there for, it's tax-free income for 14 days a year, number 1, or you could do this thing called Form 8829 where a portion of your house is basically rented. It's rented out to you as the business owner. You have to have really clean books on this one, by the way. There are way easy ways that it could be beneficial to you as a result. Now, what I would say is the concept's easy. This is going to take some work to see if it's in your best interest. What I would say is go to your tax professional, see which way it works, because there's a whole number of different ways that it would work. By the way, we do this. If you want to go to vastsolutionsgroup.com, we can also help you in this regard. In line with that, small changes equal big write-offs. Some people say, that's not that big of a deal. Really? 14 days a year of tax-free income? Anyway, or, this could be a big one. Let's just say you spend, I'm making this up, 2 hours of your time on this. But if it equals, I don't know, $30,000, probably worth your time. By the way, I'm going to remind you, even for events, this can also work out because educational events can be deducted as well. Now, the most important of all, and this is an easy tax hack. Now, I'm going to say if you put together a tax plan, you have to put together a plan, right? That's number 1. Most people don't put together a plan. You have to plan correctly for down the road. Remember, as I mentioned a few times, you have to, you don't want to write out a check April 15th. What you want to do is figure out what your tax liability is the previous January 1st and then work backwards, right? But if you have a plan in place and you're proactively thinking about it and you're sticking to the plan, that's the most important thing. If you're meeting with your tax professional, I don't know, let's say it's 4 times a year, I don't care what it is, right? And you're doing your books on an ongoing basis so you know where you are, that's the most important thing. People think, well, wait a minute, really? Does that really matter? Well, let's just say it ends up saving all these things could save you a bunch of money, right? If you're not doing all 10 of them, something's wrong with you, right? We have a couple of bonuses at the end, right? So if you're not doing some of these things to help you to lower your tax liability, something's hugely wrong, right? But everything starts with this foundation of getting a plan in place. All right, here's this one no one talks about. We're big into this one. This is the biggest thing we're doing going forward. And we call it bonus tax hack, at least in this circumstance. If you're doing any AI innovation whatsoever, now let's say as an example, you're doing innovation. Let's just say as an example, you want to do innovation using Claude, Perplexity, Gemini, ChatGPT, right? In your business, usually the government in that example will give you money. They're not going to give you money via tax deduction. To a certain extent, they will, but they're going to give you tax credits. The government will give you tax credits for using ChatGPT. Are you using ChatGPT in your business? I'm going to wait 2 seconds. The answer is probably yes. You are probably eligible for federal tax credits. It's as easy as that. Talk to your tax professional, contact us. That's what we do. We love doing that because everyone's using ChatGPT now. Everyone's using Claude, Gemini, Perplexity, whatever the case is. Well, why not get paid for it? Why not get money back from your federal government, from your Uncle Sam? Boom, here, Uncle Sam's going to give you money. There you go. By the way, also state credits. One resource is taxcreditintel.com, taxcreditintel.com. It's the #1 source for this stuff. It's so easy to find out if you're eligible. Go to that website, by the way. Again, taxcreditintel.com. It's as you see, the #1 R&D tax comparison site. You'll see if you can be saving some money. And that's a bonus hack that could save. I mean, we just saved a guy $53,000 in Florida. By the way, he said, we don't have state tax credits. Well, we're applying for the state tax credit as we speak. And because they don't have federal taxes, they don't have state taxes, you just think, this isn't going to work. Well, we've had many communications with the state. Sounds like it's going to work. Also, this is a big one. This is a big reducer, and it's the granddaddy tax hack. So legal, by the way, all legal. 831B. So let's say you have a bunch of risk. I mean, a whole bunch of risk. I mean, huge liability, because there's some big hitters who are probably watching this, listen to this. Well, you basically get self-insurance and you're writing a check for your own insurance company that you've set up. By the way, that component's a lot of work. Anyway, but this is worth looking into. #1. Then #2, on the backside, you don't have to take it as income. You hear me, right? You write a check deductible on the backside. When you get that check in the insurance company you set up, you don't have to pay for earnings. Now, there's a lot of specifics. I would say talk to your tax professional about that. If you're not doing 831Bs, something's wrong with you if you're a big hitter. We just are doing one for a doctor in Texas, and he's going to end up saving $700,000 in taxes. Now, I'm not saying that's normal. That dude's loaded, right? But just you get the concept. And really, for all 10, now 12 of these tax hacks, at least something to think about that you should be doing to lower your tax liability, all ethical, moral, etc. So real quick recap on the 10/12 tax hacks. Reps, when I talked about 750 hours as a real estate professional, I'll go clockwise. Your travel generally speaking is deductible. Bookkeeping, use usually AI bookkeeping. Or what I should say is AI powered bookkeeping, and have clean books. You'll be happy that you did. Asset classification, understand the difference between short and long term. And if you're doing short term, you got to do it really, really you got to think about taxes before you get into the deal. Home and education, if you're going to claim the Augusta rule, et cetera, do it in a smart fashion. Make sure that you're doing it the right way. Proactive planning, that's the most important. We're going to come back to that to recap. Entities, make sure you're doing right by your entities. Talk to we have a tax attorney. Talk to, Bob, as an example, Bob Bloom, remember I mentioned Bob Bloom at vastassetdefense.com. Smart guy, brilliant attorney. He's been around the block when it comes to taxes, putting together entities for asset protection, but also for tax compliance and tax strategy. Depreciation equals friend. Depreciation equals friend. If you can accelerate depreciation via bonus or accelerate depreciation, you'll be happy. Again, depreciation equals friend. Income shifting depends on how you do it. You could do it in such a way that you're going to be very, very happy if you move it to some income to a spouse or otherwise. Self-directed investing, I went into that. Now, that's a big one. Again, I'm going to remind you, people don't think that you could put real estate into IRAs, into 401ks, into profit sharing plans, or even parenthetically defined benefit plans. The answer is you can. They're worth looking into, really worth looking into. Once again, there's two other ones I threw in there: defined benefit, 831Bs and R&D. Two things you need to think about. And the most important of all of this stuff: do proactive planning. Really do proactive planning. I keep saying the analogy of, April 15th comes, you have to write your check to the IRS to your favorite uncle, or favorite uncle you don't like, Uncle Sam. Well, no, work backwards, man. Start proceeding, the previous January. Try to figure out what your tax liability is, and then figure out how to mitigate and lower that tax liability. Okay, here we go. By the end of the day, on Friday, as I mentioned earlier, for sure you're going to get the free bookkeeping I mentioned. Okay, that's number one. Number two, tax reduction package for $1,495, $1,495. You're going to tax strategy roadmap, free bookkeeping if you sign up, again, Friday, 5 p.m. today, with this offer that you're getting. And then 1 year of access to our free vault. In our vault, we have a number of items that are worth looking into. Well, let's see. First, some of the resources that you would be getting: the Entrepreneur's Manifesto, a collection of smart financial advice. Remember, I mentioned that I'm a former contributor to the Forbes.com as far as small business. These are a bunch of articles I've written. And these are just one of the resources that we've given out free by being a member of the Vault. Again, telling business secrets to entrepreneurs. We have a number of resources there that are huge for business owners. And for $199 a month, I would say it's a value, because me as a business owner, I want, one, connections, but two, also resources like this. When I say connections, a lot of our business owners are very well heeled and they're looking to do deals. So you might be able to find a co-investing partner if you're looking for a co-invest, or if you are looking to sell a house. We've had a couple of deals done. If you're looking for financing, whatever the case is, usually there's someone in that community of over 800 people who can, who are willing to work a deal. Another resource in the Vast Vaults here, $1 Billion Bullseye by my friend Jonathan Kronstad. He started Kajabi.com, and Kajabi is it's probably one of the biggest communities. The software helped define communities as far as putting together communities, running communities. He knows a thing or two about building businesses, real estate, etc. As again, he wrote $1 Billion Bullseye. He's written a number of other books, and they typically call him Jonathan Kronstad. He knows his stuff, right? That's number one, or number two. And then also here you see Rich Dad Poor Dad. This book changed my life, by the way. It was written by a guy named Robert Kiyosaki with a lady named Sharon Lecter, big name CPA. She's the one really who, by the way, I'm doing some speaking tours with her as we speak. But what I would say, depending on when you see this, what I would say is Rich Dad Poor Dad changed my life, made me a real estate investor, made me an entrepreneur. And she's one of the individuals who's also a part of the Vast Vault. A number of benefits and resources are in that Vast Vault. You get a number of templates. We've given over $50,000 of services away for people who are a part of the Vast Vault. If you're interested, just in the Vast Vault, go to our website at vastsolutionsgroup.com. But again, if you sign up for the Tax Strategy Roadmap, free AI bookkeeping, you get free Vast Vault access, and then all your tax strategy would be reviewed by a licensed tax professional. I'm going to jump on one more thing. Now, why work with us? This is kind of important, because who knows, maybe we're not a fit, but at least we can help your tax professional, your CPA, and really understanding a little bit more about some of the tax strategies here. These are 10 easy tax hacks. Now, a lot of CPAs might not know some of these because they don't work with real estate investors or they don't work with entrepreneurs. That's what we do. Right? That's solely what we do. As we say here, Kevin, Mr. O'Leary, Mr. Wonderful O'Leary says that, and I quote, vastsolutionsgroup.com has been using AI to save entrepreneurs on taxes, as he says so eloquently. Check them out. You will be glad you did. Now, without further ado, I'm going to ask once again, go to the Vast Vault or go to vastsolutionsgroup.com, see if we're fit or see if we can help you or see if your CPA or tax professional needs help. What I would say is automatically, if you go to the website, we'll give you access to the Vast, what we call vastbookie.ai or to our free bookkeeping software. Right now we're taking signups for a wait list. But what I would say is it's free. Do you want to pay for your bookkeeper? Maybe so. We'll keep paying $199, $200 a month, right? Number one. Also, number two, do you want to take advantage of a tax strategy that's in line with some of the things we've talked about, the 10/12 things that are going to help make you pay less in taxes? Totally up to you. In either way, if you want to copy this presentation, also get a hold of us at vastsolutionsgroup.com. Free community. We love the community. I'm going to remind you, there you go, Sharon Lecter, the resource. Now in closing, I want you to know about something. Earlier I said something about me writing a book, modernmillions.ai. Again, modernmillions.ai. I've written a book. This has really been in the works since 2010, if you think about it, because we've been researching artificial intelligence, ways to use it for your business, et cetera, et cetera. Now, if you go to that website, you could sign up. There's going to be a pre-release copy that's going to be sent out here momentarily to you as it becomes available. Normally you'd pay $9.95, but it would be free if you go to the website at modernmillions.ai or even vastsolutionsgroup.com. Now, this isn't just a normal book. It's really if you will, a playbook for ways to use artificial intelligence for your business. Also to, as it says, make millions, save millions, protect millions. So it's kind of a combination of ideas that are going to help you as far as AI, saving millions, lowering tax liability with AI, and protecting millions with asset protection strategies that are going to help you, the business owners, because you don't want to work your whole life and all of a sudden lose a bunch of money because of a frivolous, crazy lawsuit. And there's ways to get around that based on artificial intelligence, by the way. I mean, automation is the way to go. If you're not automating your business in some way, you're crazy. By the way, remember how I mentioned you can save federal tax money by doing so? The R&D, tax sec, whatever it was, kind of the bonus number one, if you think about, or number 11. Well, that's in line with that. Protect millions. Okay. Now, you've stayed with me this long. I really do appreciate it. I mean, if you're not interested, I get it. If you know of someone who would be interested in some of these concepts, please forward on their name to us. We'd love to chat with them. Really, what I would say is it's all about helping people to do the right thing. Remember how I said the IRS isn't going to give you a call. You paid, what I say, $100,000 in taxes. They don't want you to do that. They don't want you to overpay your taxes. Well, some of these tax hacks are going to help lower tax liability for someone out there. So if you know of someone, please forward this to them. Once again, this is Kenneth French, vastsolutionsgroup.com. Please get a hold of us if you're interested.